Welcome to our inaugural Citi Market Watch series. We hope to bring you timely views across the markets, in addition to investment strategies that make sense for your portfolios. I'm honored to have Audrey Cheong join us, our esteemed Citigold Private Client Portfolio Counselor and a regular fixture on our Citi Outlooks. Audrey, thank you for joining us. My name is San Loy. Firstly, our CEO would lose all his hair if we didn't kick off this conversation with a precise Citi view. So Audrey, let us set the scene, please.
Thank you, San. Post-pandemic, Citi views remains very much risk-on. Markets were extremely dislocated and have seen a strong and continued rebound based on normalization driven by vaccine rollouts and historically strong policy support. It is worth noting that not since the war have we seen such aggressive policy globally, and especially in the US, both in terms of scale and speed. This is reflected in our asset allocation, and we are decidedly overweight equities over bonds. We are overweight all equities across all classes and regions except for the US and mid and small caps, where we recently brought these allocations back to neutral. For bonds, we are overweight high yield and emerging market sovereigns, but underweight developed market treasuries and neutral on investment grade bonds. We are otherwise underweight cash, neutral on gold, and positive on thematic equities.
Thanks, Audrey. Markets have been spectacular since March last year and through the pandemic. This year, Citi analysts are forecasting about 5% for global GDP growth, with the US expected to be around 6%. However, China is expected to grow at 8 to as high as 11%. Audrey, what's driving this stellar growth in China?
Aside from China managing the virus well, the big picture has always been China's urbanization rates and the skill of its emerging middle class. To put that in context, China's middle class at approximately 500 million is already larger than the population of the US. Perhaps what is more acute and exciting is the incredible rate of technological adoption in China.
Yes, and the pandemic has truly accelerated this. China was already leading the world in terms of e-commerce, and through 2020, we have seen online e-commerce increase from 20 to 30%. For context, whilst even the US has moved higher, online retail in the US is now only around 16%. Yet China's technological adoption has been broad, extending through to renewables, healthcare, and even e-gaming. China has literally all the e-buses in the world. It has twice the number of electric vehicles compared to the rest of the world and has by far the largest installed capacity for wind and solar. We see renewables not just as one of Citi's unstoppable trends, but also a generational game changer. Simply because on its own, without subsidies, renewables is now by far the cheapest source of electricity on planet Earth. No longer are coal and natural gas defining grid parity. Audrey, we are seeing sustainables, or environmental, social, and governance, or ESG in short, as top of mind in so many conversations. What's driving this?
Well, aside from Europe and China's existing focus on green investments and infrastructure, the key driver has been the press surrounding President Biden's $2 trillion green infrastructure plan. Infrastructure has been long ignored in the US and is now proving to be a unifying goal. Polls show that President Biden's popularity in only his first 100 days is currently at 59%. The US has rejoined the Paris Accords and recently hosted the Global Summit on Climate Change.
But Audrey, the US has disappointed the world for so long. President Clinton signed the Kyoto Protocol, only for President Bush to then pull out. President Obama joined the Paris Accords, only for Trump to pull out literally in his first week in office. The world sees no US leadership in tackling climate change.
President Biden's $2 trillion infrastructure plan does make headlines, but the most important ingredient to note is the clean energy standard. If legislated, it would mean that within the decade, most of coal and possibly natural gas-generated power will be shuttered. So by 2030, the US would literally be a global leader in reducing greenhouse gas emissions. This standard will drive incredible change for the US, raise or reinstate America's credibility, and unify the goals set by the Paris Accord.
It really feels like the world can be saved. Pivoting back to China, what's interesting is that China is the world's largest manufacturer of solar panels and equipment, and a major manufacturer too for wind turbines and blades. China also recently announced its own ambitious net zero emissions 2060 plans, which means that China too will need to build out its renewables capacity very aggressively as fossil fuel power is turned off. And this dovetails nicely into China's digitization, 5G, energy storage, and electric vehicle efforts and plans. It is also worth noting that despite China's rising affluent middle class, it barely spends 4% of its income on healthcare, which pales in comparison to the average 18% spent across developed economies. China is demanding more healthcare solutions, and the government has stepped up with its Healthcare China 2030 plan. The principal reforms and goals of the 2030 plan are to educate the public on nutrition and health, whilst at the same time ensuring that public healthcare demands are met. For example, we are already seeing China having the largest diabetic population in the world. That's 114 million people, or 27% of the world's population. And for many other chronic diseases, from liver and stomach cancer to heart disease and Alzheimer's, these are all top causes of premature deaths.
Wow, there are so many things firing in China. GDP growth in China is being supported and fueled by very deeply entrenched themes across multiple sectors across the economy.
Indeed, the point here is China or Asian equities are well aligned with our Citi views and allocations. We are also seeing particular weaknesses and opportunities now, given the year-to-date correction driven by the broader reflationary and inflationary concerns, and some regulatory tightness we have seen both on the monetary side and within the technology sector.
But the key question that clients are asking is, are the markets too expensive given the strong run that we had last year?
Yes, valuations have been very high. And in some sectors like technology, valuations have been at levels second only to the highs reached during the dot-com bubble. But the key difference, especially for technology, is that unlike the dot-com era where tech startups then literally had no earnings, we are now in 2021 seeing very strong earnings. Consensus-wise, for 2021, we are expecting earnings growth to average 26%. And year-to-date, earnings have not disappointed. Given the broader dislocations across the other sectors and strong earnings, for example, with stay-home companies like home improvements, there continues to be lots of opportunities across the markets. And this is a key reason why many see the current environment favoring stock pickers or active managers over passive investments. That's it, Audrey. We have seen the froth come out of markets thanks to the concerns around inflation expectations. This is another development many clients are concerned about. What are our thoughts on inflation?
The US inflation expectations have risen sharply. However, it has not been as bad as the 2013 taper tantrum. From the lows of last year, we have seen US 10-year rates rise from about 0.31 to almost 1.8%, and it has since settled back to around 1.5-1.6%. We continue to see inflationary risks as transitory as opposed to persistent. And this is supported by core inflation remaining below its 2% target and factors like wage growth remaining flat. That said, Citi analysts do see the potential for nominal inflation to rise to 3%. In addition, the Fed has moved to an average inflation targeting model such that inflation would really need to be persistently high and above 2% over multiple quarters before they would move, meaning that the Fed will likely stay lower for longer. Finally, the world has been driven by broader deflationary forces for decades, like demographics, trade, and technology, sometimes referred to as Japanification and Amazonification of the world. And all these deflationary factors are not going away.
Thank you, Audrey. We have covered a fair amount of ground today. In summary, Citi is optimistic and constructive as the global economic reflation continues. We see strong themes playing through, for example, the rise and faster growth across Asia and China, and this is additionally being fueled by other themes like ESG, renewables, healthcare, and strong government policy support.
Thank you for joining us on this inaugural episode of our Citi Market Watch series. Speak to your Citigold or Citigold Private Client Relationship Manager for more on these opportunities, and we'll see you next time.